Right. Good morning, you all in the virtual, right?
Good morning, ma'am.
So let's see the outline. Actually, I think it is visible to you. This is business finance. Actually, the financial management is the traditional term for this business finance. So basically, we learn the things related to the financial management, but anyway, I will explain the difference between the financial management and business finance. So you can see the learning outcomes really at the end of this unit or at the end of this your semester, you will learn these things related to the financial management or business finance. Basically, you will learn what is the business finance and the role of finance manager, then the functions or the areas of the decisions in financial management, and also the very important concept is value. When it comes to the financial management, so the concept of value is very important. So you are probably finding in the third lesson, that is time value of the money or calculating value. So every other discussion based on this value, or you will learn how to calculate the present value or the future value of the cash flows that you are receiving in the different time period. So without knowing that calculation, you cannot maximize our objective is maximize value. So to maximize the value, you should know how to calculate the value. So that one we have discussed under the third topic. So you can see apply the value of money concept in the real world scenario. So you will learn how to determine the value for the different cash flows that you are receiving in the different time periods. And also you will learn risk return. Actually, we are not going to deep discussion in the risk return, but anyway, you will learn how to construct a 2-asset portfolio at least. And also, finally, you will learn what is the diversification effect. So that is the aim. That is the aim. So with that, you will learn by constructing the portfolio, investors are constructing portfolio to get some diversification benefit. So that is diversification means maximizing return at a minimum level of risk. You will learn this, right? So you will identify that effect, diversification benefit or diversification effect. And then under the corporate finance, areas under the corporate finance, you will learn capital structure, decisions, dividend policy, and certain things related to the working capital management. And finally, if time is permit, we will discuss certain basic things related to the derivative. So these are the intended learning outcomes. So at the end of this 13 or 17 sessions, we will learn these things under this course. Right? So these are the intended learning outcome. I have uploaded these things. Have you seen it? In the LMS? Did you check the LMS? Yesterday, I uploaded the outline, some reading materials, and also PowerPoint for the discussion. So you can see them, right? Right. So these are the main topics or the lessons that we are going to cover under this business finance course module. So today we are going to discuss this introduction to the financial management and also certain things we are going to discuss under the financial markets, financial environment. So really financial management we are starting might be in the next week. that is time value of money. So we are starting from that point, value calculation. So that is like the heart of finance. So without knowing that calculation, so you cannot go further in security valuation, in cost of capital estimation, in capital budgeting, and also in working capital management. So you should know this concept. You have to apply this value. So therefore, our third lesson is like the heart of finance. So we are discuss that one after the introduction and the environment and the financial market discussion. Then return and risk related discussion, as I told you earlier, we will discuss portfolio aspect with the diversification benefit. Then cost of capital estimation. As a finance manager, sometimes since you have doing some professional exams, you might have discussed these things, right? I believe. But anyway, I will explain from the bottom. But I believe that you have certain level of knowledge because you are doing certain other courses. Am I correct? Huh? So cost of capital means that is actually the for the capital budgeting, for the investment appraisal, to evaluate the investment project. So we should know what is our cost of capital. So that is our minimum required rate of return from our investment. So you should know how to estimate that variable cost of capital for a firm or a company. So that is we are discussed under the cost of capital lesson. Then capital structure, that is complicated area in the finance or the business finance disciplines. But anyway, under the capital structure, we supposed to learn certain concept like what is leverage, what is operating and financial leverage, business risk, financial risk. So likewise, certain concepts you are going to touch. We are not going to deep theories like theory, capital structure, related agency theory. So like this large area is there, but we focus on the basic fundamental level discussion. Working capital also another big area in the financial management. It is also very complex. Actually, that working capital management coming under the corporate finance textbooks or corporate finance discussion. This is at the end of the corporate finance. If you look at the corporate finance textbooks, you can see that working capital management is at the end of these books. So therefore, that what I want to say, this is very complicated thing, working capital management. So in the business finance, in your disciplines, in this subject, you are learning very fundamental, very what you call very basic level things related to the working capital. But when we say the working capital management, you have to know how to manage the receivables, payables, inventories, operating cycles. So like this, vast areas of knowledge is there. But anyway, we focus only to basic concept and basic understanding under the working capital management. Dividend policy and also the introduction to the derivative also the same. So what I would say, you are learning nothing under the business finance. Because when we say the business finance and the financial management is a very vast area, we have a lot of things. If you are specializing in finance related, I think you have certain specialization, no? Business in your this degree. You have specialization? General, no specialization. All right. But anyway, if a specialization, if you are doing a specialized degree in the finance, you will learn this working capital, capital structure, then investment portfolio management into a deep level. But in this business finance, in your course, we discuss under the fundamental and the very basic level discussion, right? So you can see even in the aim of this subject to identify the basic level of understanding under the business finance topics. Right. So let's go to the detailed outline is there. Right. I'm not going to explain one by one because we are going to learn them. But anyway, you can read them. What are the things or what are the sub areas that we are going to discuss under this main headings or main topics. So that detailed outline is included. So you can read it later. What I should say, evaluation. You can see that cost of capital, capital structure, budgeting decision, then working capital, dividend policy, and the derivative. Evaluation, when it's come to your evaluation, you will get 40% of your total 100 marks from the continuous assessment and 60% from the final paper. So this continuous assessment or this summative evaluation will consist with this individual assignment is not, right? I am not going to do this individual assignment. Instead of this individual assignment, we will do classroom quizzes. 4 quizzes, but the problem is I have a problem how to manage with this hybrid nature with the classroom quizzes. You have experience in the previous classes through the LMS. So normally I'm doing, I'm uploading to the LMS. So then you have to access to the LMS within the 30 minutes live. So you have to attempt it. It is possible now with this hybrid platform. Right. So therefore, for this individual assignment, you are not given any individual assignment. So we will conduct 4 quizzes. I will show in the course outline in the session plan. So these quizzes mean multiple question, 30 minutes, maybe 15 question, multiple time. Right. So this 10% you will get from the quizzes. 4 quizzes are planning. So at least from these 4 quizzes, at least you have to be present for the 2 to get this 10%. So you have a chance to miss 2 quizzes. 4 quizzes are there. You have to be present at least 2. Right. So in any case, if you are for this particular lecture, there is a chance another 3 quizzes are there. Okay. I clear? Right. So then group assignment and presentation, that is 30% of the weight. So I will allocate certain topics, probably on this global financial market, new trends, financial environment, new certain products are there in the financial market. So on these aspects, we are going to do the group presentation. So have you the pre-arranged groups with you? How many groups are there? 6. Right. So later you may give the details of the groups. So then 6 mean we can manage. So that is, I will allocate the topics by next week or after next week. I will give you the topics and the area of your group assignment. So you have to prepare as a group. You have to submit the report also, outline for the report, and that content of the report I will give you. And then presentation will be held at the end of the maybe before the 2-3 sessions of the end, I will arrange the presentation. I will show you the session outline by next week, because still I can't plan today is the first lecture. So this is 30% paid group assignment and group presentation. So the final exam is 60 minutes. Right. So that is the way of evaluation. So you have to be prepared. I have prepared 2 section papers previously. So you can look at them. I can share either. So the same format like they are given here. You can prepare the papers also. Right. Recommended textbooks. Right. This can't be this is the recommended textbooks. But anyway, I'm not requesting you to purchase this one. Don't purchase, because related to the particular topic, I am uploading the relevant chapter to the LMS. So then you can read it. That is a self-reading. So this recommended textbooks chapters I am uploading to the LMS. For this today's lecture also, I have uploaded introduction part. So you may download it and you can read it for your additional knowledge and for further understanding of the things that we are discussing. And the other one also is somewhat advanced, not like the foundation book. Other than this two, there are certain free downloadable financial management corporate finance books. So you can read any, because this topics normally in any textbooks you can see. So therefore you can download any books from the I think in the Google you can download them. So you can read. Better to read, because the things that we are discussing here in the classroom is not sufficient. You have to work in the home. So we are spending 3 hours or 4 hours here. But anyway, that's not sufficient. Because these days I am marking the papers of the previous 2 batches. Actually, I can show you the paper. Paper was based on the things that we discussed in the classroom. But anyway, students are not scored. They have not scored it. So therefore, you have to work hard rather than just listening in the classroom and spending the 4 hours here, not sufficient. You have to have a tutorial, you have to do them by yourself, you have to practice them. Past papers you can see and you can do yourself. So likewise, you have to do certain things in order to get a good marks for this subject, because the scores or the marks are very low in the previous 2 batches. Right. So that's all about the outline. Any questions? The other thing, actually, this is a very what I call you. This is a very flexible lecture, right? You can talk with me anytime. Just like keep in hand like this. Don't sit like this. You can interact with me. You can ask questions, because in the next week. From the next week, we are going to do the calculation. Today is a very introductory part. But anyway, I prefer if you can ask question, you may have some clarification. So you are welcome at any time to talk with me. I'm flexible. If you can't understand anything, you may ask. 2 times or 3 times or 4 times, I can explain until you are getting that. Right. What else? Okay, so then we can start the today's lecture, that is Introduction to Business Finance. Session plan I will upload to the LMS with this presentation deadlines and the things once we finalize. Students in the virtually also, if you have a question, you can ask, right? Not only to this physical students. I think I can see how many students are in virtual. There are 3 students. If you have any question, you can ask. Just raising hands, I can't see you, so you may talk with me if you have any questions and any clarification. Right. Business finance. Introduction to the financial management is your topic in your course outline, but your subject is business finance. There is a difference. Okay? Introduction to the financial management is the lesson. Your subject is business finance. Right? So can anyone tell me? Hey, we'll start with the financial management. Right. Before going to that one, under this introduction, we will discuss what is finance, what is financial management, and also you will learn major functions, so the major decisions in financial management, and then objective of financial management. You might have learned marketing, HRM, operational management. So there are certain objectives for this subject. So likewise for the financial management or this business finance, we have objective. Very unique, very specific objective. So you should know that before you can't do the value calculation, what you call the investment project appraisal without knowing the objective of financial management. So we will discuss the objective of financial management and finally, agency problem. Right? So these are the things actually we are going to cover under this introduction part. Right. If I ask a question, as you feel, what is financial management? What is finance? You can, as you feel, what is financial management? You might have learned accounting, different disciplines in accounting, cost accounting, management accounting, financial accounting. This is financial management. So when we say the financial management, if I ask you to write the definition for that, what is financial management? You can talk or you can write. What is financial management? That's huge. Hence, what is financial management? What is your name? Tattoo. Your name? Galle. Galle. Good leaders. Excellent. That's why I asked. What is financial management? What do you think is the financial management? You are going to learn the business finance. So what you are expecting to learn? Allocating resources. Get the best output. Allocating resources. Right. So when we say the resources, what are the resources in a company? So because we are discussing related to a company, this is not the personal finance, this is corporate finance. So in a business, in a company, in a firm, what are the resources available? Only money. Assets. There are real or the physical resources as well as money like non-physical resources. Right. So to achieve a certain output, what is your expected output? What do you want to achieve by managing money? Financial management means managing funds, managing cash, managing money. HR means managing human. Marketing means managing product and service. So financial management means management of cash flow, management of funds. So to achieve certain output, certain objective. So what is your aim? What is the objective? Maximize it. Do you have any other objective? You can talk, huh? Otherwise this will be a boring lecture because 4 hours, 4 hours meaning. That was in bargain for credit. 4 hours, 1 hour tutorial. No. If it is structured, 3 hours lecture, 1 hour tutorial. Your cost structure. Anyway, 4 hours will do the lecture. Right. Right. So profit maximization. Is it the only objective in the company? Profit maximization? Do you have any other objective? Investment.
With the goals.
Achieve the goals. Goals. The broad sense. Goals mean. I am asking what are the goals? What are the objectives? That's much market share. What is? Still, I didn't get the objective of financial management. What else?
Minimize the question.
Huh?
Minimize the question.
Yes, minimizing the cost, possible objective. But it's not the objective of financial. Yes. Maximizing. Coincidence, yes, possible objective. But it is also not the objective of financial management. Anyone who say objective of financial management? Yes. You. Ask you. You have a certain idea. Fine. Anyway, you will learn. Objective is not the profit maximization. So, right, they are going to learn this thing. Right. So look at this. Introduction to the financial management is our topic. So these are the learning outcomes. At the end of this 3 hours or 4 hour session, you will define what is finance, what is financial management, what is the difference between these two, what is business finance, right? And also you will learn role of finance manager, key decisions of financial manager, objective of financial management, and finally agency conflict and the agency relationship. So these are the learning outcomes. So at the end, you will check whether you have learned this aspect, right? You can check by yourself whether you have learned this. So these are the learning outcomes. Right, finance. Finance, financial management, two different classes. Right, two different classes. You are learning here, not finance. You are learning financial management or business finance. So what is finance? Finance refers to the management of money, as you mentioned, and the allocation of resources in various ways to achieve the specific goal. To encompasses a broad range of activities, including investing, borrowing, lending, budgeting, saving, and risk management. So you mentioned these things. So finance is a broad concept. When we say the finance, it consists investment, credit, borrowing, working capital, dividend policy related things, capital structure related things, money and what you call the market, money market, capital market investment. So likewise, finance is a broad concept. When we say the finance, this is a broad concept. So you can see this definition is not very specific. This is very broad. You can say it encompasses broad range of activities like investing, borrowing, lending, budgeting, saving, risk management. Right? So there are more than this. Insurance, personal finance, international finance, entrepreneurial finance. So likewise, all these things are included in the finance. So this finance is a broad concept. Under this finance, you are going to learn here financial management. Right? Finance is a broad concept. Under the finance, if you are specializing a degree in finance, you will learn investment and portfolio management. You will learn what you call business valuation, derivatives, international financial management, capital market related thing, insurance, banking, personal finance, entrepreneurial finance. So likewise, all the things are included under the finance broad area. So under this finance, you are learning here business finance or the financial management. So in very simple way, finance is the broad concept. Financial management is one component included in the finance. Right? Finance crucial aspect of both personal business decision making, as it involves the analysis of financial data, understanding financial market, application of various financial strategies to optimize outcome. Even public finance included under finance. Public finance means finance related to the government, fundraising and the funding investment. Right? Right. So therefore, when you are looking at this explanation of the finance, you can see it's very broad. It's very broad, not very clear. It's not very clear. It includes many things. So that is finance. So under this finance, you are going to learn this corporate finance. So basic areas in finance: investment, financial institution, international finance, public finance, personal finance, entrepreneurial finance, all are included in finance. But in your course, you are going to learn financial management or business finance or corporate finance. Actually, traditional term used for this corporate finance is financial management. Right? If you look at the textbooks 30 years back, you can see there is no book, say corporate finance. These are books mostly on financial management. Right? So that is the traditional term. So now this management has evolved. Right? So now actually after the corporate finance, now the next next term is the business finance. So you can see this is the path. Financial management, corporate finance, business finance. So financial management is a traditional term we use for this financial management of a company, financial management of a firm. Then it evolved to the corporate finance. So more specifically under the corporate finance, the focus goes to the company, corporation. Financial management of a corporation. So it's narrowed to the company or the corporation, public limited company. So like this. Now another evaluation is there, that is business finance. If business finance is brought that to the corporate finance. So under the business finance, it considers all type of business organization. Can be a sole proprietorship, partnership, company, operation, and also non-profit organization. There is a financial management for the non-profit organization also. So therefore, current term is the business finance. But anyway, the content included in this corporate finance, financial management, business finance, the concept, fundamentals, principles under this area, this aspect is same. These are not changing, but anyway, these terms has evolved like this. So there is the difference between financial management and the business finance. So your topic, your title, your post title is business finance. That is very correct. I think it is correct. If your title was say like financial management, you are not in like outdated. Financial management now it is outdated. Now the correct or the currently good or the acceptable term is business finance, corporate finance. Now you can see the textbooks more on the corporate finance and also the business finance. Right? So that is the difference between finance, financial management, and business finance. So I explain this three. Okay. Now there are certain other areas under the finance. Investment. I think in your slides I have given the description for these areas also for you understanding. Investment mean investment. Just read this line. This is what I explained because some points might have. Just read this line. You can see the first bullet. In early stages in financial management, we primarily involve basic financial functions such as accounting, budgeting, financial reporting. At this early stage, actually, the accounting and finance was not two different fields. At that early time, accounting and finance recognized as the same. But now, accounting is totally different from finance. Now, if you look at the institutions, universities, you can see there is a separate degree for the accounting specialization. There is a separate degree for the finance. Now, this is a two different fields. Even in the now you are working at the fact that you are in companies now you are working on, so you can have that experience. Under the chief financial officer, accountant is there, control is there, financial management is there. Right? So likewise, now two different designations. Different responsibilities and areas are there. But at early time was a very connection between the accounting and finance. Over time, financial management evolved to the corporate finance, indicating broad and more strategic approach to financial decision making within a corporation. Accounting is more routine function. It's more routine. By looking at the past financial year or the past data, you are preparing financial statement. Auditing. Okay, that is very routine. But finance manager or the financial management is not a routine job. It involves strategic decision making related to the financing, investment, raising funds, and investment of the funds. So that is a very dynamic as well as the strategic function. It's not a routine thing. You have to look at the environment, what is happening in the financial market, interest rate, policy rate. So you have to take the decision. So that is dynamic. Corporate finance is the area of finance that incorporates the actions of company, comes making decision about financing, budgeting, managing working capital, financial analysis, financial statement development. So likewise, so under the corporate finance, you will learn all these aspects. Business finance encompasses an even wider area of financial activities and strategic consideration within overall business context, but certainly not limited to corporation. So that is the difference. So when we say the business finance, it's very, it includes wider area, not like the corporate finance, it considers the other type of business organization also, even sole proprietorship. Sole proprietorship also, there is a financial management. So they are doing a financial investment and finance, they are achieving their objective. So there is a financial management. Did you get the difference between finance, financial management, corporate finance, business finance? Any question? I prefer introspection. Then that is very live. Otherwise, I'm talking about the I will fire with one of us to talking. Okay. Now, if I ask a question for your paper, explain the difference between the what is called finance and financial management. Can you ask? Can you ask? Right, teacher. Maybe. Maybe you can, you know what, maybe can give the what a page out, we have mark in the question table, I realize it. Make them on the document, is there any damage students? You can't understand single. How about you? Right. Better on the document, no, basically, so they are very poor in writing. Actually, that is a very, that what I realized with this marking, that's a very critical problem. Writing is very poor. Answering the question. So therefore, actually, I told in this semester to spend certain time for the tutorial to answer the question. So then I can look at the your answers randomly and I can comment on it. So then when we are marking, we are looking at certain component of your answer. Certain component should be there to allocate a marks. But anyway, your answering is very good. You're not focusing when you answer. Right? Anyway, we'll take tutorial and we'll try to late comers.
Excuse me, madam.
Yes.
The thing is that we are facing some problems when you write in the whiteboard. When you use in the whiteboard, we cannot see it properly. So the previously what we did is that previous lectures they used that whiteboard in the screen that in the I think one desktop you are using, no, that in the same desktop there was one whiteboard, so they used that one, then we can see it through the Teams, but right now we cannot clearly see the whiteboard. That's the main issue, madam.
Okay. I got your problem. Even the whiteboard, I am not familiar with the thing. I'm using Zoom. Next time for the lecture, I will bring my notepad. So then I can write on it. I can connect this notepad to the laptop. Then I can write on it. But anyway, so that is possible. Anybody is there to assist me to look at this smart maybe. When you mean that smart board? Yeah, smart board is there, that won't be a problem. So then that is sharing. But the problem with this traditional whiteboard. Right. Anyway, for the time being, please tolerate this issue. I will talk with the coordinator and I will come up with a solution, right? For the today's, you may bear this one, right?
Yeah, madam. Okay, sure. Thank you.
Yes, right. Okay. Right. Right. So you can see here I have given very small explanation for the investment. Investment means actually the investment of the companies. Maybe the capital market investment, money market investment, foreign exchange market investment. So these aspects also come in under the finance. So you can read and you can understand this thing. Financial institution. This is a separate discipline, separate area coming under the finance in broad category. Financial institutions. So you have to learn money under the main job or the main role of the financial institution is the financial intermediation. Financial intermediation, transferring funds from the surplus units to the deposit units. So that aspect in detail we discuss under this financial institution. So that is also coming under the broad area finance. So the other thing, international finance. Cross-border, when a company is doing a business in the different countries, when they are doing the importing and exporting like this. So then we have to discuss financial management related to this international context. Certain areas are there, right? It's a different subject, different discipline. So that is also a subject coming under the finance. Public finance, finance related to the government. Government, there are certain theories, certain discussions, certain concepts under this public finance, separate subject. Right, personal finance. That is also very interesting one. Certain things that we are discussing under this business finance, you can apply for your personal life. Like time value of money, when we discuss the time value of money, certain applications we are discussing. So this application, you can apply for your personal decision making. As a person also, you are trying to maximize your value. You are trying to maximize your value. So that is our objective of financial management, even in the public finance, entrepreneurial finance, international finance. The objective is same. Maximizing, creating value, not the profit. Right? It go beyond the profit. So I will explain that concept. So our objective is creating wealth, creating value, maximizing value. So likewise in the personal finance also, as a person, you are managing your cash inflows, cash outflows to maximize your value, maximize your value. So that is another subject, but it is also coming under the broad sense of the broad area of the finance. Entrepreneurial finance. I will explain that one. That is, you should know. Entrepreneurial finance and corporate finance. What is the difference? Entrepreneurial finance means, so normally you know that early startup companies, or what you call the venture, entrepreneurial ventures. So they are starting at the introduction or the development level. So then they are going to the survival stage, then rapid growth, maturity, and the exit point, or at the harvesting point. So at this exit point, this entrepreneurial venture should decide whether this company is converting to the PLC company, whether the company is converting to the private company, or whether they hand over it to the another generation of this management. So likewise, certain harvesting strategies are there. So up to this point, the things under the financial management we discuss under the entrepreneurial finance. After this exit point, after this harvesting, that is corporate finance. That is corporate finance. Up to this point, entrepreneurial finance, that is related to the early startup companies. At the development stage, what are the ways of raising capital? At the survival stage, how to manage their cash. They have to estimate cash burning, cash building, and then rapid growth, maturity, and then exit, harvest. So after the exit, that is coming under the corporate finance. In this range, in this area, that is entrepreneurial finance. So that is also another discipline. You can see entrepreneurial finance is the application and adoption of financial tools and techniques to the planning, funding, operations, and valuation of entrepreneurial venture. Early startup company. Entrepreneurial venture. Right. So that is also another discipline coming under the finance. Right. So I think now you have realized broad sense of the finance. Right? When we say the finance, it is very broad. It includes public finance, personal finance, entrepreneurial finance, international finance, investment, capital market, financial institutions, everything. Right? But you are learning here public business finance or the corporate finance or financial management related to a firm, related to a business, not the personal finance. So you are learning in this course the financial management related to a business firm. So that is the difference. So that is the end of that point. Any question if you have, you can ask. Right. So with this diagram, you can identify role of finance manager. You can see this is a very small diagram, but anyway, when you look at this big picture, that is a very important role is there. Role or the function of finance manager. So what you can see numbers are there, rows are there, sorry, arrows are there. Now, if you look at the number one is coming from financial markets to finance manager, right? So you can see the indicator of this first arrow. That is coming from the financial markets to finance manager. So that is what the first job or the first role of finance manager is raising funds, fundraising. So you can see the first one coming from the financial markets. So financial markets mean that is the place where investors are. People or the individual with the excess funds in the financial market. So therefore, we are raising funds by using different instruments, different ways to the business. Now say company, public limited company. What are the ways of raising funds? Public limited company, PLC company. How they raise capital? By issuing shares. Shares mean in general by issuing ordinary shares. What else? Yes, preference shares. What else? What are the ways of raising capital by a PLC company, public limited company? Yes, they can issue debentures, bonds, and also they can take the bank loan. And also they can issue the commercial papers. Do you know what is commercial papers? Can you explain what is commercial paper? We can't do it. Commercial papers. Finally, commercial paper means only companies operations, especially PLC company, publicly limited companies, they can issue a paper. It's a, we call a commercial paper like this. That is a kind of paper, special paper, to raise their short-term financial requirement. Basically, commercial papers, so what is the secret? We go find the public. Yes, commercial paper. That is raised, that is actually the companies, they are issuing commercial papers for raising short-term funds requirement. But if you take the ordinary share issue, preferred share issue, dividend issue, so that is for raising long-term funding. Commercial papers we are using to raise the short-term funds requirement. So like the commercial paper, I think you may condition the treasury bills. Particularly treasury bills. Commercial papers also like a treasury bill. There is a net face value. Take a commercial bank. If they are issuing a commercial paper with the 100 rupees, this is the face value. This is the face value of this commercial paper. Investors can purchase this commercial paper at a discounted price. The maturity is less than 1 year. This is a short-term financial instrument, so the maturity is less than 1 year. So if you purchase the commercial paper at say 80 rupees, at the maturity, say it is a 6-month commercial paper, at the maturity you are getting 100, like a treasury bills, So, but these commercial papers are issued by companies, corporations. Right. So likewise, finance manager should decide the way of raising funds. If it is a sole proprietorship, what are the ways, what are the sources of finance? Sole proprietorship. How to raise your capital? Bank loan. What else? On that sole proprietors own asset, own money. They can use basically the bank loan. They can borrow from the other friends, what we call tools, families, or like that, other informers also can use. So the first role of the financial manager, even in the sole proprietorship, financial manager is there. Not only in the PLC company, right? Even in the partnership, financial manager is there. So then the first job, first role, or the first function of financial manager, raising capital, raise funds from investors, right? Raise funds from investors. So under this, we discuss under the cost of capital. In our future, there is a separate lesson for the cost of capital. So under the cost of capital, we calculate cost of raising funds. In future, you will calculate when you are say companies issuing debenture. Say you are an investor, I am a company. So when I issue debenture, you may purchase, you may invest. So you are a debt holder of my company. You have your requirement of return. I have to pay coupon. So there is a cost. So then under the cost of capital, we are calculating cost of raising funds. Right, don't confuse at that point, I will explain again. So the first job, first role of financial management, a financial manager, raising fund. Second one is, what is the second? Going from finance manager to firm's operation. Arrow is heading from finance manager to firm's operation. So what is that role? Cash invested in firm. Firm means a portfolio. Firm means a project or the portfolio of investment. So once you raise capital by issuing debentures, by issuing ordinary shares or the preference shares, as a finance manager, you can't keep these funds in a locker. You can't keep this fund idly. Immediately, you have to invest these funds in a project, in the investment, in a firm. Firm means actually the investment. This is a portfolio of investment. So then you have to invest these funds in appropriate investment. Because in raising capital, you have a cost. Suppose if you have taken a bank loan. For the bank loan, you have to pay interest. Say bank loan interest is 15%. Right? Say bank loan interest rate is 15%. So you first, there is a financial markets. I'm writing this way, right? This is the company. This is the firm operation. So first one is raising funds from the financial market. Suppose you are taken a bank loan at the 15% interest. So then you are investing this fund. Suppose you have taken a 1 million at the 15% interest. So I invest in these funds in a particular project, in the investment. Say, internally generated rate of return of this project, say 12%. You have taken a bank loan, you have raised funds using a bank loan at 15% interest per annum. So these funds you are investing in a project. Your project generating return, say IRR, internal rate of return, say 12%. What you can say about this investment? Is it rational? Is it a feasible investment? No, because the cost of raising funds is 15%. Your investment generated rate of return is 12%. So from this investment, even you cannot cover the cost, right? So you cannot maximize value. You cannot create value from this investment, right? So therefore, you should know what is the cost of raising funds in order to take this investment decisions rationally. From your investment decision, you should generate more than its cost. So then you can maximize some value. Then you can create some value. If your rate of return is 12%, means your bank loan interest even you cannot cover. So then long run, you will be back out. Because your investment, you are not investing in the proper project, a good NPV, positive NPV project. So therefore, in the long run, you may have financial distress, you may bankrupt. So therefore, that is very important, knowing the cost of capital or the cost of raising funds. Without knowing that cost of raising funds, you cannot invest. In our future, our topic is capital budgeting. Ape outline में there is a topic capital budgeting. So under this, we discussed how to select good investment by comparing with the cost of capital. Right? So the second job is investing the funds in the appropriate project. Third one, cash generated by operations. Cash generated by operation. Just investing, not the point. From the investment, finance manager, that the financial manager's responsibility, generating cash flows from the investment. Now you know that as an accountant, you are preparing cash flow statement. What are the components of the cash flow statement? What are the three components in the cash flow statement? Cash flow from operations, cash flows from investment activities, cash flows from financing activities. What is the most important one? Three sources, three components are there. What is the most important component? Why? That is correct. Cash flows from the operating activities. Why it is important? Because cash flows from financing means raising funds. Why should we debentures? So you are raising funds from the investors. Cash flows from investment means that is the investments of the company. Once you generate funds, if there is any excess or the additional extra funds, you are investing. So cash flow from operations means that is the cash generated from your core activities, from the business. So that is the internally generated cash flow. So the cash flow from operations shows you the internal health of the business. internal health of the business. So it shows how you generate the cash flows from your core business. If you are a manufacturing company from this business, you should generate some cash flow. So that is affect to the value creation. That is affect to the value creation. So therefore, in the cash flow statement, as you mentioned, the most important component is cash flows from operating activities. Right. So the third one is cash generated by operations. Now in this project, in this one, cost of raising fund is 15%. IRR or the internally generated cash flow from the project is 12%. Is there any cash generation? No. There is no cash generation. So from the investment, you should generate some cash flows more than this cost. Then you can create some cash. So that is responsibility of the finance manager. Finance manager of the company should invest in the good project, a positive NPV project. With the positive NPV project, you can generate some return. You can generate some cash flows. Then in the 4A, 4B, the second role is there is a two versions of the form. 4A, 4B. 4B means from the generated cash flows, you have to pay some return to the investors. If you are taken here bank loan, from the generated cash flow, you have to pay interest because you have to pay the interest to the bank. If you are issuing debentures, from the generated cash flow, you have to pay coupon. If you have issued ordinary shares to raise the capital, from the generated cash flow, you have to pay what? For the ordinary shareholders, dividends. If there is a preference shareholders, you have to pay some dividends. After that, after paying their required rate of return, maybe interest, dividends, or whatever, some part of that generated return you have to reinvest. For A mean that is cash reinvested. From the generated return, you have to reinvest it to further future investment. So that is, this diagram shows you the role of finance management. So in an organization, in a company, in a business, in a small firm even, finance manager is responsible for this job, for this role. He should be responsible to raise the funds. He should be responsible to invest in these funds in the appropriate investment. From this investment, he should generate some return for the company. Then he should decide from the generated return how much they are retaining, how much they are paying as the dividends or the whatever interest. So that is actually the dividend policy. Under the corporate finance, there is a separate topic that is dividend policy. So we are discussed this dividend policy under this related to this area. If you match our topics in outline for this diagram, from that number one, that is financing. So that is coming with the cost of capital. 2, capital budgeting. Then cost of capital estimation, capital budgeting, and then dividend decision. Throughout this process, working capital management is there, capital structure decision. Even with the first one, capital structure. The base you have financed the certain capital is your capital structure. Right? All these topics you can fit. You can match with this diagram. You can reflect. You can, by looking at this thing and by looking at the course outline, you can fit this title or these topics for this diagram. In future, we are going to discuss. Right. Any question? Any questions? Any clarification? Right. So now with the identification of this role of financial management or the role of finance manager, now we are going to identify decisions. Now we are going to identify decisions in finance or the financial management. In order to discuss this topic, decisions in the or the functions of finance or the functions of financial management, I will give you the exercise. What is the exercise? Suppose that you are going to start a business. Right? Just five decisions, 5 or 10, even 5. In your book, you may write 5 decisions that you have to take. Then you are going to start a business. Take out a practice. Five decisions that you have to take. Then we are going to characters. At least 5. You may write 5 decisions that you have to take when you are going to start this business. Kindly let me know when I'm writing in the slides, those who are in the virtually. If I edit the slides, you can see.
Yes, madam, we can see.
All right, but in the next week, I will bring the notepad, so then I can use it. This one, the students also can be sure that one. So then that way we will manage, right? Today I haven't my work notepad with me, but anyway, in the next week I will bring it. Then I can work on this slide, so then you can see both. We can see. Okay.
Okay, madam. Thank you.
Right. Because at the moment I can't use the pen using this mouse. From the next week I will bring. Right. Did you finish? So you may write 5 decisions that you have to take by people standing or I will listen. Okay. Decisions. So, when you are starting business, you usually have inside. How we are using the capital. What is your base of the business? So like this, you have to take decisions. So that, but it's right, 5 decisions. So this is a product, by the market. Right. Right. Now let's look at the definitions of this thing. After that, we will look at your answers. In finance or in financial management, in the broad sense finance also, these 4 decisions you can identify. Basically, the decisions you can identify mainly, if you look at the different textbooks, these decisions mainly divide into 2. Right? The decisions mainly divide into 2 as investment decisions and financing decisions. Right? Mainly, we can divide these decisions into 2, investment and financing decisions. Under the investment decisions, again, you can categorize long-term investment, short-term investment. Under the financing also, you can categorize short-term financing and the long-term financing. So that is also, you can see if you read the textbooks, these decisions mainly categorized into 2, financing and investment. Financing and investment mainly divided into 2, financing and investment. So this financing and investment again divided into 2 as short-term in financing and long-term financing. Here investment also short-term investment and long-term investment. Right? So without dividing like this, in here in this slide, it has listed decisions as investment decision, financing decision, dividend decision, working capital management decision. Investment decision means another term that we can use for the investment decision, capital budgeting decision. Under our course outline, our one topic. What is this capital budgeting decision or the investment decision? That is related to the long-term investment decision. When we say a long-term investment decision, how to define a long-term investment decision? If the impact of this decision, if company is receiving for a long period means more than 1 year, more than a counting period. So that is we call long-term investment decision. Now say for the example, if you are with say company purchasing a machine, it's a long-term investment decision. Because the impact or the return from this machine, the company will get for a long period, maybe more than 1 year. 1 year is the benchmark. If it is less than 1 year, it is normally we define as the short term. More than 1 year, it is a long term. So under the first one, investment decision means long-term investment decision, or we call capital budgeting decision. So this is actually this part. Long-term investment decision. So if I ask, tell me the example for the long-term investment decision, you can tell many long-term investment decisions that a company is taking. Now you can in your exercise, you have written certain decisions, long-term investment decision. right? Then financing division. Financing means raising capital. Financing means raising capital. Again, this is a long-term financing decision, right? Under this financing decision mean again, this is long-term financing decision. Long-term financing mean now say you can take bank overdraft. You have a current account, you can take bank overdraft. Is it a long-term financing? No. For a certain requirement, you are taking the bank overdraft. If you have a supply to pay, so you may take overdraft and you may pay. That is for a short period. Maybe within the 1 year, you may sit down it and it is over. So that is a short term. So this is the financing decision made. This is not the short-term financing. This is long-term financing decision. Long-term financing decision again, this relates to the composition of various securities in the capital structure of the company. Capital structure of the company reflects the long-term financing decisions of the company. What is the capital structure of the company? So the base that company raise their assets. So that is their capital structure. Maybe the debt capital, equity capital, and the preference shares. Debt capital means by taking bank loans, by issuing debentures. Equity capital means by issuing. What are the equity capital source? Shares. Which one? Ordinary shares. Preference shares mean preference stock capital means preference shares. So this is the capital structure of the company. So the long-term finance structure you can look at by looking at the capital structure of the company. So it says this relates to the composition of various securities in the capital structure of the company. So financing decision means raising capital for the long-term investments of the company. So you may raise capital by issuing debentures. Debentures issued to the right content. Then you are not paying debtors by issuing debentures. No, you may issue debentures to do some long-term investment, to invest in the long-term project. Likewise, so the financing decision made in raising capital for the long-term investment. So that is this part. Financing, long-term finance. More simply, how company is going to finance its long-term investment. Either equity or debt. That is the capital structure. Right. So then, dividend decision. In my list of the decisions, the third one is the dividend decision. Dividend decisions regarding the distribution of the profit. Distribution of the profit. Once the company is earning profit, the finance manager or the director board should decide which percentage they are retaining, which percentage they are paying as the dividend. So we are calling retention ratio and the what is the retention and payout. Retention means retaining amount, payout means paying as the dividend. So that is we call dividend policy of the company. Dividend policy consists with retention policy and the payout policy. Right. So that is the decisions that finance manager has to take related to this dividend declaration, dividend or the reinvestment related activities. So that is coming under the dividend decision. So this dividend decision can impact in short term as well as long term. Now say for the example, if a company issue dividends for ordinary shareholders, in short term, what is happening in the capital market? A company issue dividends, ordinary shareholders. In the short term, immediately, what would happen in the market? Market price, how would happen? Take a market pricing. When a company is paying dividends, short term, maybe within very short period, what would happen to the market price of that company? Is it decreasing or increasing? Huh? Huh? Increasing. That is based on the research you have to say it is decreasing. Because when the company is paying dividends, investors are perceiving that they are paying dividends, so now their cash is decreasing. They have no internal cash for the reinvestment, so that goes to the bad signal to the market. Immediately, it is problem. But in the long run, there are investors for the dividend with the perspective of getting some dividend. But in the long run, when the investors are looking at such a company which are paying dividends, they are motivated, they are attractive for investment of this particular company. In the long run, the company stock price or the market price is increased. So likewise, there is a short run effect as well as long run effect. So with the dividend policy, the impact can be short run as well as long run. Right? So that is why under this classification that dividend impact we can discuss with the short run effect as well as the long run effect. And also the dividend declaration, because you are with matured students, so I'm talking too much, right? Don't complicate it. Right? With the dividend declaration, dividend can be a financing decision and also dividend can be an investment decision. Do you agree? Dividend can be a financing decision as well as an investment decision. If you read the recommended textbooks and other textbooks related to this part, you can see some textbooks explain dividend as a part of financing. Because now companies, when they earn 100 rupees as a profit, if they decide to pay 50% dividend, 50% remains for the reinvestment. So that is affecting to the internal finance, internal cash flow of the company. So on that aspect, dividend decision, some textbooks argue as a part of the financing decision. Right? 100ක් ටික ඉවොත් 50ක් අපි ලාභාංශ විදිහට ඉවොත් 50ක් අපිට ඉතුරු වෙනවා investments. So that is a finance. And also some textbooks argue this as an investment decision because when the company is declaring dividends, it goes to a good signal or a positive signal to the market. So it makes the attractiveness to the company. So potential investors demanding shares of this particular company. So as a result of that, company market price of the share is increasing. So that is affecting to the value of the company. So this is a part of the investment. So likewise, you can broadly you can think about this in broad sense. So this dividend decision can be argued as a part of financing decision as well as part of the investment decision. Just for your information. For the, some other classroom students are arguing how the dividend is coming under the finance, how the dividend is coming under the investment. So likewise, you will read additional reading recommended textbooks are given for you for the reading. So you may look at and also look at the research articles. So there is a certain debate, certain arguments related to this aspect. Right. Last one is the working capital management decision. So what is this working capital management decision? That is related to the short-term financing and short-term investment. Working capital means it is the capital that companies has for day-to-day operation, for a short-term obligation. Then what was it? There is a working capital. Company has certain money in the locker to maintain, to pay the electricity bill, whatever they may. Electricity bill, inventories, raw materials, suppliers, utility bills are there. So to pay this, there should be certain money in hand, the bank. So that is we call working capital. There is a separate discussion for the working capital, but unnecessarily, there are many money. that's good. Because this 100,000 is earning nothing. It's always zero. So keeping unnecessarily working capital with the business, it makes that cash recycling. It's not earning any return. It's keeping in your locker. So therefore, you should know what is your working capital requirement. So you have to keep optimum or the required level of working capital. Unnecessary, if you give large amount of working capital in the business, it's subject to the profitability. It is our investment, it is our profitability. So under the working capital, there can be a working capital financing, working capital investment. Now, if you take a bank overdraft, what is it? If you take a bank overdraft, is it it is working capital? It is coming under the working capital, long-term investment, long-term financing, it is coming under the working capital. So that bank overdraft, is it a working capital investment or working capital finance? Working capital financing. That is a short-term finance. Right? Say working capital investment. Then after investment spent in that company, long-term investment spent in that. So you are putting this money in the treasury bills. What is this? Working capital investment for a short term or short-term fixed deposit. Right? So these are the four decisions that finance manager has to take. Investment decision, long-term investment, long-term financing, working capital management. Under the working capital, two categories are there: working capital investment, working capital financing, and the dividend decision. Categorize under the financing, short-term financing, long-term finance. Short-term financing means working capital. Under the financing, under the investment, short-term investment and long-term investment. Short-term investment means working capital. These are the issues of financial management. Company not government will see no decisions. Any decisions that company is taken, you can categorize into these categories. Right? Now you have written here your decisions. Now we are going to categorize them. Shall we have a break before that exercise? Do you need a break? Huh? Only break. Break again. What is the timeline? 10 minutes. Right. We'll have a 20 minutes break. Right. We may come back within 20 minutes, right? Nandapon, are you there? Can anyone respond me in the virtual platform?
Yes, madam.
Yeah, may I just to may clarify. Now you can't still may not enough visible the may whiteboard.
No, madam.
No, ne?
No. We can see the whiteboard.
Huh?
I think we can't see.
When writing, no?
Yes.
Yeah. So as a solution, I think if this lecture is facilitated with the whiteboard, I think that's better, no? Because now they are separately, they have put a camera here.
Yes. Yes, madam.
In my side, I thought that if I am using this, what do you call that, notepad is possible, but anyway, that also not a solution, I think.
Last time, madam, they used a smart whiteboard, no?
I didn't hear.
Last time they used smart whiteboard.
Yeah. Smart board is there, so then that is, I think,
Yes.
very.
We can enable it.
Yeah, I will retest it because otherwise you may not get the things, but actually, especially in the next lecture when we are doing the calculation, that
Yes, madam.
very difficult.
Yes.
I will ask them to at least for this lecture, smart board. I will inform. I hear from your side also the class coordinator can ask. Huh?
Yeah, we will tell the class coordinator. to inform.
Yeah, better to request, right? I also inform when
Okay.
I finish this lecture today.
Okay, madam.
Okay, thank you.
Okay.
Yeah. Shall we start? Yes, okay. You are not the coordinator. Maybe better to request not. But I think so Mama Priya Nam was saying that is there not depending here. So we can question become even. At least that possession letter or even focus on because may say what that making possession change maybe gonna table is not helpful. We could put that camera And we can start again. So now we discuss the decisions or the functions finance manager. So now there are certain examples for the decisions. What you have to do, you have to categorize them. Whether it is investment, financing, if it is investment, whether it is long term, short term, it is working capital, you have to say whether it is working capital financing or working capital investment. So likewise, you may take 6 examples of them. Let's take 5 minutes and categorize or divide them under this different types of decision. Then you can look at your examples, your decision also. Right? Very easy. And whether what is this decision? Let's say example, 6 examples. Identify whether it is investment, financing, working capital. What is the category? What's the decision? I think that's enough. No time. Right. We'll start from one. Green PLC issued 10,000 new shares to the market at the price of 100 rupees each. What is it? Yes. Long-term finance. Correct. Beta PLC software company decided to introduce a new computer system. Long-term investment, because a software company, they are introducing a new system. So that is a long-term investment. Three. Expo company decided to maintain inventory level worth of 100,000 rupees. Working short term working capital inventory level at 100,000 rupees. Their inventory level at 100,000. Working capital, yes, inventory or working capital short term. So is it a short term financing or short term investment? Financing or investment? What is inventory? We are keeping this inventory for a short period until it is selling, no? That is inventory. So then it is, what is it? Short term. Inventory is asset. We are keeping. So we are like inventory. We are investing in inventory. Inventory, inventory का converted into asset. इधर अभी लेकर credit card इधर financing का it's an investment. For a short period, you are keeping it in your store, whatever, until it is selling. So that is a. या अभी तो inventory रुपया सीधे रखते हैं, अभी एक पुराने किसी से इधर एक investment का तो finance है, हाँ? The investment, not a finance. Inventory is a short-term investment. We get it earlier. We are going so that is a short-term investment. Okay, fixed deposit debt short-term, interest fixed deposit debt and quantify the joint value. Likewise, so not a finance. A financing can be why going to one type of people telling like that. Why? Maintain an inventory level worth of 100,000. It misleading. Maintain. Normally, inventory is an investment. If you are investing, now suppose that you are recruiting a labor. Say in a day itself. What is the condition? Hiring not a recruitment, hiring a labor. Cloud. What is the decision? I told you any decisions in the organization you can categorize into these categories. Hiring or recruiting a cloud. What is the decision? Suppose that like this recruitment of say chief financial officer with long qualifications, CFA, double J, CBA, whatever, with everything with qualification, double D, PhD, everything. What is that? Huh? It's an investment. Resource investment. After the Julian Neve, 40 last week from market, so we are expecting something from that we would place asset. So they have to have some return for the company. They have certain targets. Even target. So that is a part of a short-term investment. So we are taking some job. So with that job, we are getting some return. So that is the investment. R&D expenses, research and development. So companies are spending on the research and development activities. What is that? investment. So most of the decisions are going on the investment. Right, now you can look at your decisions also. So then it is clear, no? Inventory is a short-term investment. Receivables, debtors. Company receivables. Receivables have to be covered by the credit sales. Short-term. Short-term, right? Short-term receivables. That is the amount that receivable that is to be received within next month, within next 2-3 months, within the short period, within the year. The receivables. Short-term is asset එකක් නේ අපි accounting වල is asset අපි asset එකක් කියන්නේ ඒක අපිට ලැබෙන දෙයක් it's a asset එකක් how to define asset අපිට මේ currently item තියෙන return එකක් අපි අනාගතේ generate කරන දෙයක් so that is asset so that is also short term investment right creditors payables short term finance අපි ගෙවන්න ඕන ගෙවල නැහැ ඒ සල්ලි ටික අපි තාම මේ business එකේ තියාගෙන ඉන්නවා that is the short term finance bank overdraft short term finance fourth one XYZ company has declared 1 rupees per share dividends to the existing shareholders dividend decision so you can categorize in that 4 categories that is under dividend. Again, as I explained, you can argue this as in the financing aspect as well as the investment aspect. In the dividend, there is a short-term effect as well as a long-term effect. That is the dividend stock. 5. Alpha PLC has decided to expand the business by entering into a new market. Have any question? Have a question, you can ask me rather than ask him. What is that? Enter into a new market. Long-term investment. Last, ABC company has decided to extend 60 days credit to their customers. Short-term finance. Credit period එකක් දීලා බඩු ටික විකුණ ගන්න බලන්න. So that is a short term finance. බඩු විකිනෙන්නේ නැහැ. අපි කියනවා ආරණ්‍ය යන්න අවශ්‍ය නැහැ කියන්නේ. So likewise. So that is a short term financing. Now just look at your decisions. If you have any problem to categorize one of your decisions you have any, you may ask. Now you have some decisions now you discuss them all decisions. So now look at your decisions and just categorize them. Any difficulties there, you can ask. Now we have 5 decisions. Divide among these categories. What is that? But the next one. Machine mode is machine. What is that? It's a finance. Now it is clear. But now any confusion with some example, you may ask. Layout of the business. The layout of the business is a Division divisions categories categories layout of the business. Layout company company, the layout is subjected to the trusting satisfaction, customer retention. So that's subject to the turnover and the cash flow of the company. So there is a order. We took encourage to one for the so there is a choice. Anyway, it's a part of it. Like equation. Right. So then we are going to the next part. Right. So this is what you can look at in now we are working in some organization. So you can look at the structure, organizational structure. So we are the finance manager, right? Financial manager can be under the chief financial officer, CFO. So under the CFO, accountant and finance manager both is there. Traditionally, the designation was treasurer and controller. Treasurer and controller. Treasurer is similar to the finance manager's role. Controller is similar to the accountant. So the treasurer is responsible for the decision making, some dynamic functions like cash management, credit, raising capital, banking activities like. So that is more towards related towards to the finance manager. Then controller, similar to the accountant. So that is very routine function, preparing financial statement, tax calculation, auditing. So likewise, that is related to the very routine things that is aligned with the accountant. So this is under the chief financial officer. These two designations can be there. In a modern organization, you may think about. Now you are working in some companies. Look at the organization structure. See where the finance manager. See where the financial, this role of financial manager is distributing among the different different designations. So this is some modern view, modern organizational structure. Again, you can see there is a functional managers, here finance manager. So under that, treasurer and controller can be there. So you can see not further designation like under the treasurer. So likewise. But anyway, there is some overlapping. This is some theoretical presentation of the organizational structure and this role of the place of the finance manager. But anyway, in a modern organization, it is changing. Now with the there is some virtual type organization. So likewise, functional managers are going here and there. So now this can be some differences and also changes can be there. But anyway, remember there is a two designation under the finance manager, controller and treasurer. Controller more close to the finance manager, sorry, controller more close to the accountant, treasurer, finance manager. That you should know. As activity, homework, download 2-3 annual reports from the stock market website, CSE website, and look at the organization structure and look at its dynamic. They are different from organization to organization, they are different. So you can search where the finance manager, where this treasurer, where this controller as a homework, just to get some overview. Just to download freely, you can download 298 companies annual report from the stock market CSE website. take 2, 3 and look at where these people as a homework. Right. Now we are going to the next point. So far we discussed what is finance, business finance, financial management, and also the functions of financial manager, the role of financial manager, decisions of financial management. The next point is objective or the goal of the firm or goal or the objective of financial management. As at the beginning you mentioned possible objectives like this. If I ask what are the objective of your business, you can write many. You can list down many possible objectives like survival, making market leadership, maximizing market share, beat the competition, expansion and satisfaction, employee satisfaction, customer satisfaction, minimize cost and maximize profit. These are the possible objectives. When you are learning human resource management, what was the objective of that HR? I think today you know. What is the objective of human resource management? Retention and satisfying the employees. In the marketing, getting the market share, increasing the product quality, so likewise related to the product and service. So likewise, you can write down many possible objectives. Right? So there is two approaches when we discuss this goal or the objective of financial management, traditional approach and the modern approach. Under the traditional approach, we call the economic perspective. Actually, at that time, objective of financial management was maximizing profit. At that time, at the early 1950s, the objective was, yes, profit. What is the profit? How to calculate profit? How to calculate profit? Profit is equal to income minus expenditure. So it's an accounting concept. You can calculate income minus expenditure. So maximizing profit. One tara maximizing. So at that time that was the objective, but in the modern approach, after this 1950s, like with the developments and evolution, the objective of a firm, either corporation, sole proprietorship, partnership, anything. Objective of the business, objective of a firm, objective of a company's, objective of financial management even, maximizing shareholders' wealth. We can present this objective in the different format, maximizing shareholders' wealth. If it is a public limited company, there is a shareholder. They are the owners. So that for that company, you can say maximizing shareholders' wealth or maximizing shareholders' value. If it is a partnership, sole proprietorship, there is no really shareholder. So then you can write maximizing value, creating wealth. Even for the owner, there is a owner. Right. And also we can present the same objective, maximizing market price of the share of the company. If it is a PLC company, ownership with the market shares. PLC company ownership with the shares. So then the same objective you can present as maximizing market price of the company. When the market price is maximizing, what is automatically happening? Shareholders will is increasing. So likewise, if you read the reading materials, the textbook, you can see this objective presented in the different form, in the different ways. Maximizing market price of the share, maximizing shareholders' wealth, maximizing owners' wealth, creating value. So like. Right. So now we are going to discuss what is this wealth, what is this value, how to maximize. So these things. right? So the one thing is now you clear, the objective of financial management is not the profit. Right. If I ask a question, what is the difference between income and wealth? This is very personal finance related question. You have income and you are doing your plan. You are working guys now. So you have may at the end of each month you are getting some package, you are getting some salary. So you have yes, you are getting 100, 200,000, 300,000 for like that. You are getting some income. So how about your bill? Income is there. You have to maximize your bill. Have you created value for you? What is the difference? What is the difference? Income and wealth. Income is actually, you can say the salary is the income you are getting at the end of each whatever the period. But the wealth is not the income. Some people are there in the society having very small income, but they are very wealthy. They have created a lot of value for their life. Some people is there, they are having large amount of income, but no, they haven't created any value. They have no any wealth with them. So what is the difference? Simply learn what you retain. The retained part will create the value for you. There is a difference. So you can see in the last, I think it is explained somewhere. Conversely, a person can have a low income but high wealth if they inherit large sum of money or own valuable assets that appreciate over time. So there should be some asset with you. This is explaining in the personal finance in wealth. This is related to the personal finance nice topic here. You have some asset that should appreciate over time. Suppose that you have an income, you have invested some money, say in a real asset, in a land. You have some, say, vehicles or whatever, some motor vehicles. And also you have invested your money in the fixed deposit. You have certain investment in the capital market. In addition to your main income, you have certain amount of money you are invested in the different investment, different assets. They are creating value over time. So then you are wealthy. In the personal finance, it says that that wealth maximize the decide the rule of thumb. If you lost your monthly income, if you can survive at least 6 months, you are certain type of a wealth maximize. That kind of things are there. So there is a difference between the income and wealth. I have put in the very simple format. So that is, you should have some asset. That asset should create some value over time. If you are invested with the company ordinary shares, it's creating value for you. When the market price of the share is increasing, your wealth is increasing. Creating value. Okay, further discuss with the discussion. So the point is getting monthly salary is not the objective of the personal finance as well as not the objective of financial. You should maximize your wealth. You should create some value for you. In order to create some value for you, you should have some investment, some asset that is creating value over time. Right? So that is the difference. I confuse it. You get that point? There is a difference between income and wealth. It's not the value, it's not the wealth. That is a cash flow, that is a main income. The rating in Lanka, consumption, investment, and other liquids are there. After all, take a winner. Right. So that is the difference between income and wealth, because our objective is wealth maximization or value creation. Right. Now let's discuss why that profit maximization is not our objective. In the modern, in the traditional world, for 1950s, at that time it was the objective, maximizing profit. But now, with the development, with the evolvement, now it has realized that profit is not the end point. Profit is not the end point. In financial management, you should go beyond the profit. Because now let's suppose you have a business. The business is not ethical. There are business not ethical. But that person or that people also getting some profit. So then they can maximize profit. Either ethically or unethically, you can earn profit. But wealth, value, you cannot create unethically. So this is conceptual. You may argue with the practical, it is happening like this, but it is not the conceptual. Right. Why the profit maximization is not be considered as an objective of financial management? Because profit is a bad or the unclear definition. It's a rate. Because you know that profit is equal income minus expenditure. If you take the income statement, how many profits you are calculating? From the beginning to end, gross profit, then what is before the depreciation, before the interest, after the depreciation and the interest, before the tax, before the dividends, after the dividends, so likewise net profit. So likewise certain type of profits you are calculating. Which profit you should maximize? Whether it is net profit or operating profit. Operating profit means earning before interest and tax, PPI. It is not clear. Right? So when it comes to the profit, there are different concepts for the profit. So that definition is not clear. Which profit you should maximize? You must read that pretty badly here. That part is first chapter. It is explained in very lengthy paragraphs are there explaining why this profit maximization is not to be considered as our objective. It is not a good way. Definition is not clear. And also, it ignores the risk. I will explain it later. It ignores the cash flows. I think as accountant people, you know, when you identify income as well as the expenditure, the accounting rules and regulations, normally the point that particular transaction is occurred, we consider as the point of the execution. Not the point that cash flows is really received. Therefore, credit sales, credit purchasing are considered when you calculate the profit. Okay? The income statement. So, and also, you may remember there is a depreciation. Depreciation is not a cash item, it's an uncashed item. And also some provisions are there like for the tax and goodwill. So likewise provisions can be there. So therefore, sometimes companies are having say 1 million, 2 million profit, but the cash flow is negative. Cash flow is negative. So profit is not a cash flow. For the accountant, for the tax purpose, for the in order to avoid the tax paying, so you can what you call window dress. You can manipulate the profits. You can decrease the profit by increasing the provisions for the tax purposes. So likewise, the profit is personal. You can manipulate. You can express as large one, and also you can decrease or you can manipulate it. So therefore, the profit is not a cash flow. Profit is a non-cash item. Even though you are having a large amount of profit, it doesn't mean that you are having the cash. So then we decline profit maximization option. And assumption, as I mentioned in the accounting actual basis. Okay? There are certain assumptions of when you identify income and expenditure, actual basis kind of thing. So these are assumptions. A lot of assumptions are there when you calculate the income statement profit. And risk and timing. What is this timing? Now, if you take the revenue in the income statement, that is annual revenue. In this revenue includes sales happened in the January, sales happened in the June, sales occurred in the December. We consider it as a sales for the year. Right? Say sales occurred in the January, you have reinvested for 11 months during the year when it's come to the December. And also the sales amount you are receiving in the December, you consider equally as the sales amount you received in the January. So we are not doing any adjustment for the time differences of this cash when we calculate the profit. We consider the cash flow received in the January as well as the cash flow received in the December, same, equal. But there is a time gap, there is a time difference. That is wrong. We have to adjust these cash flows for the time differences. In financial management, the core or the heart of the financial management is the value. So we have to consider time differences of the cash flow. The cash flows received in the different time periods, you cannot compare them as it is. You compare them as it is, and if you take the decision, you may not maximize value, you may not maximize it. So when you calculate the profit, you are not doing any adjustment for the time difference. That is the problem. These are the reasons for rejecting profit. Right? We are discussing here reasons for the rejecting profit. It is not a cash flow. There are unrealistic assumptions that not consider the time differences, and also it ignores the risk. It ignores the risk. We are not doing any adjustment for the risk factor. Suppose that year 2023, our profit of the company was say 100,000. Based on the past data, you are forecasting next year profit, say 150,000. So you are simply comparing this 100,000 and the 150,000 without thinking about the risk factor. The forecasted profit 150,000 for the next period, next year. So there is uncertainty. There is a risk. Now let's, if you take like this, say here, 2023, say our profit is 100,000. So 2024, we have forecasted the profit is, say, 100,000. In accounting, so you are simply comparing these two, and you are telling that expected or the forecasted profit for the year 2024 same as this previous year profit. But this is the forecasting. This is for the year 24 now, but say this is for the next year. So when it's come to the next year, there is a risk. There is a risk. So this forecasted for the expected profit subject to the certain uncertainty. So you should be able to calculate risk factor using the standard deviation at least. Standard deviation shows the deviation of this expected May number. So then you can compare. But we are doing any things like this for the profit calculation in the accounting. We are not doing any adjustment. So these are the reasons for not to consider profit as our objective of financial management. The other one is that profit can earn unlimited. Right? Or not a profit to earn. Profit can earn unlimited. Well, technically as well as unlimited. So therefore, in financial management, the objective is profit maximization is not here. It's not what we call, if you take the chapter, you can see it's explaining later, not is superior to that. It's not clear, so it might be, it's not that clear. It's a very narrow. Right? So then what is our objective? Maximizing owner's wealth, shareholders' wealth, maximizing market price of the share, maximizing value of the company. So that is the objective. When company maximizing market price of the share, human resource manager achieving its objective, marketing manager is achieving its objective, production manager is achieving its objective, every stakeholders are satisfied. Employees, customers, potential investors, all are satisfied. When you are reaching to the value maximization, when you are creating value for the owners, when you are creating value for the shareholders, all other stakeholders achieving their expectation. So when we are going to that end, we cannot ignore the other stakeholders. I mean, in company, there is a very unrest, trade union action. Employees are not satisfied. There is a conflict. Right? Can the finance manager maximize shareholders own? The shareholders or the owners value? No. It's affecting to the market price. It's affecting the market price of the company. When there is unrest, some conflict in a particular company, investors are withdrawing their investment. So then the company attractiveness is decreasing. When the company attractiveness is decreasing, in the marketplace, demand is decreasing for the market share price. Share price is declining. When the share price is declining, wealth of the value of the owners, shareholders decreasing. So that is the conceptual framework of this wealth maximization. Because public limited company, whatever the things happen in the company, reflecting in where company ඇතුලේ සිද්ධ වෙන සියලුම දේවල් like the investment, financing, working capital, dividends, or whatever the things, everything happening in the company, reflecting in where? Why is it reflected? Company share price. In the share price of the company. When there is a contact with the director board, investors make a effect on investment or value according to their reporting. Potential investors were alternative investors. So likewise, this is a long-term thing, right? It is not happening overnight. This concept is happening not like other even profitable way. So it takes some time. It's effective in the long term. If the company is earning profit unethically, companies also can earn profit unethically. The company can earn profit here, but they are destroying the pollution, they are affecting to the environment, they are damaging to the greenery, so like this, they are doing a lot of harmful things. But they are earning profit. Short run, yes, that they get the profit. What happens in the long run? If a company has a long run into the limit. In the long run, investors are looking, now there is a green investors. There is a social responsible investors in the market. So in that kind of investors, when they look at this kind of unethical company, they are withdrawing. They are not investing. So in the short run, they are pop up. There is an increase of the market price and there is an anomaly. But in the long run, they are vanishing. They are going worse. So their shareholders' wealth, shareholders' value is declining. right? So if I ask that question, can shareholders' wealth can maximize without earning profit? Can finance manager maximize shareholders' wealth without earning a profit? Without the profit, wealth එක maximize කරනවා. value එක create කරනවා. Then there should be some profit. However, we shouldn't stop at profit. That is the objective. We profit earn කරනවා. There should be some profit for the company. However, our ultimate objective is not the profit. So that is the point. Then you should understand the difference between this our objective of financial management. When we are earning profit, that's better. Yes, we should have some profit. Because company can counter satisfied, you know, not profit, but we should go beyond the profit. If this profit are income and wealth, with the profit, we should create some value. Without a profit, we should invest in a good investment, ethical investment, social responsible investment. So that our investors are attractive. So our company share price is increasing. When the company share price is increasing, company value is increasing. When the value is increasing, growth is increasing, our income, our wealth also. So that is the main network. That is the connectivity. Profit target, we are not creating value. We should target to value maximization of the shareholders' wealth, maximization of the final ultimate objective. When the shareholders maximizing their value, their wealth, suppliers are satisfied, customers are satisfied, employees are satisfied, everything is happening. All the stakeholders are achieving their expectation. Did you get this objective? The HRM objective we are going beyond. Even if the objective of the HRM, even the objective of the marketing management, even the objective of the production management, if we exceed that, we are going to that point. So when the owner's wealth is maximizing, shareholders' wealth is maximizing, every stakeholders are satisfied. Are you telling now the objective of your business is profit maximization? There is a requirement, the objective is profit maximization. That way, no, is an arrow. Did you get it? Not the objective. It is not a profit, but it should be the objective. We go beyond the profit. The profit is conceptually not a good thing. Profit current. You must read that chapter. Right? Introduction chapter. Right. Shareholders' wealth maximization by maximizing net present value of every course of action. Over the shareholders' wealth maximization, the outcome by maximizing net present value of every course of action. Even with the investment decision, financing decision, or the working capital, or whatever. With the every course of action, you should maximize net present value. What is the net present value? Net present value for any decision or any objective, any action you can calculate present value of the cash inflow minus present value of the cash outflow. That is the NPV, right? That is the NPV. Net present value is equal to net present value, NPV. Net present value is equal present value of the cash inflow minus present value of the cash outflow. If it is positive, if the difference is positive, it means what? Present value of the cash inflow, present value of the cash outflow. When you calculate in these values, you are adjusting cash flows for the hiding factor. You are adjusting cash flows for the risk factor. I'm not going to explain that thing, but in future we are doing. When we calculate the present value of the cash inflow, so you cannot calculate present value without adjusting time and risk. Suppose there is a project. Abhidu, there is a project, right? Say there is a project at 0, you are investing, say 100. There is a lifetime of the project, say 3 years. 1 year from today, it is generating 50 rupees, 150, 250. This is the project. What is the return of this project? How much? How much the return? This is the cost of the project. Year 1, you are expecting net cash inflow, right? This is net cash inflow 50 rupees, net cash inflow 150, 2 years from now, 250, 3 years from now. What is your return of this project? Isn't it? 250, 150, 50 minus 100, isn't it? 350. Your profit or your return is 350. Is it correct? Why? Discount control. Need to discount. Why? Yes. Yes. Today you are investing 100 rupees for this project. 1 year from today 50, 2 years from today 150, 3 years from today 250. That's the time differences. Right? This 50 you cannot compare with this because there is a time gap. So therefore, by adjusting this cash flow for the time differences and the risk, you should calculate net present value. Net present value means simply present value of the cash inflow minus present value of the cash out. If the net present value is positive, it means that by investing in this particular project, suppose that here for this project, NPV is positive 50 rupees. After adjusting for the risk and the time. So what this 50 rupees mean? If you invest in this project, shareholders or the owner's wealth is increasing by how much? 50 rupees. So as a finance manager, you should how to maximize shareholder wealth? By maximizing net present value of every course of action. So you have to be able to adjust the time and the risk, all these decisions, and then you have to maximize net present value. So this like this. Okay. And also by maximizing market price of the share. At the very beginning of this class, I forgot to tell that. If anyone is sleeping while I am reading the lecture, my practice is asking he or she to sing a song. I will say that you are in this classroom. So that is the name I do. So therefore, if you are sleeping, it means that you like to sing a song. Okay. Next. Shareholders' wealth you can maximize by maximizing net present value of every course of action and also by maximizing market price of the share. Then mama sorry with you. Market price of the share and profit එක වාගේ පුළුවන් ද finance manager ට manipulate කරන්න. Stock market එකේ market price එක, company එකේ market price එක. So company එකේ whatever the things happening in the company immediately reflecting in the market price. Market price is determined by how? By demand and supply. Market price of the share of the company in the marketplace in the stock exchange is determined by demand and supply. So demand is increasing when the company is attractive. So when the company is attractive, when they are earning profit, when they are performing well, when they are investing in a good project, when they have good appearance, when they are not polluting the environment. So likewise, then company will get. So then investors are investing. Then demand is increasing. When the demand is increasing, market price is increasing. When the market price is increasing, your wealth is increasing. But like profit, the accountant cannot manipulate this market price because it determined with the fundamentals. It determined with the fundamentals with the demand and supply. That is economic theory. Demand and supply then the fundamentals, economic theory. So that depends on the demand and supply. So you cannot, as a person, you cannot manipulate. Some they may not manipulate, but anyway, don't ask that. But fundamentally, that depends. That market price is determined with the fundamentals happenings in the company. There are certain fundamentals: inflation rate, interest rate, policy rates, market within company within other factors, investment. So, like certain fundamentals are there. So, demand and supply depends on these fundamental factors. Right? Okay. So now if I ask the question, I think in your paper, common fiction. Why the profit maximization is not considered as the objective of financial management? Can you explain? If you look at the past papers, that is a common fiction. Why wealth maximization is considered as the superior objective of the company? You never explain. Any questions? Any clarification? Any question? What can question come on? So then I can realize at least you are realized. Now, shareholders' wealth maximization you can achieve by maximizing net present value of every course of action and by maximizing market price of the share. Now look at this example. Suppose you acquired 1,000 shares of HNB Bank PLC a month ago for 100 rupees per share in the open market, in the secondary market. Current market price or the value has risen to 150 per share. You have purchased, you have invested at 100 rupees in 1 month ago. Now market price is 150. Now the market price of this HNB Bank PLC shares has increased from 100 to 150 during a month. Why? What is the reason? Increase in the market price, is it a good thing or bad thing? The good thing, because we may maximizing market price. So now the market price has increased by 100 to 150 within a month. It implies what? Company के good performance, company के attractiveness, and ultimately demand. Okay, what God meeting up here, the something demand. So that is the same theory, same economic theory. So market price has increased because HNB Bank is performing well. They have good profit, they have good investment, they have good customer base, they have good cash flow, everything. Everything is good. So therefore, ultimately, market price has increased. Manipulation can be there, they are doing manipulation. It's a different story. But this theoretically, market price is increasing because of the happening in the company. It determined with the fundamentals of variables. But in a market like in our Srilanka, but how many, what is the number of listed companies? 200. Number of listed companies in our market? The market, what is the financial environment and the financial market self-reading and self-study? First quizzes from that field. How many companies are there? Approximately 100. 192, 298 around. Is here what is here? 295. Just go to the CAC website. You can number of listed companies. Our next topic is Sampurni self-study. Financial environment, financial market, financial systems, component, all this self-study. First is based on that. Okay. These are the अरे नावल लेकर क्यों ना बाकी सेंट्रल बैंक वेबसाइट इंडिया सीएससी वेबसाइट इंडिया just do nothing to make it financial system financial environment you should be right calculate the increase in your wealth calculate the increase in your wealth how much the increase of the wealth calculate. Well, quantitatively you can calculate when you maximum when the increase in wealth rate is quantified. You can calculate how much the increase of the wealth. Find out the value of your wealth at the inception of this investment. Evaluate the current wealth based on the current market price. Do it. Oh, here again. Oh, right. 1,008. How much increase of the bill? When you are doing this investment, how much was your wealth? You are investing in 1,000 shares, HNB PLC at 100 each. So your wealth was how much? Okay. What's the name? 100,000. At the start, when you are doing the investment in 1 month back, type your wealth was 100,000. After 1 month, HNB market price, HNB company's market price of the share has increased to 150. So you have invested in 1,000 shares, now it is 150. So now your wealth is 150,000. So increase of the wealth is 50,000. Your wealth has increased by 50,000. So what is the objective of financial management? Maximizing this, maximizing shareholders' wealth. That is the objective. Maximizing owners' wealth, shareholders' wealth. So how is the market price of the permit share determined? I have explained now it. So that is based on the demand and supply. That is based on the fundamentals and the economic theories, demand and supply. Okay. If you have any question, please ask them. Tutorial you have to do yourself. Tutorial upload the video, so you have to do it. Right. Now, attributes of the shareholders' wealth maximization objective. Now, at the initially we discussed the problem or the limitation with the profit maximization objective. Now, these are the attributes or the characteristics of the shareholders' wealth maximization objective. The value of the company's share is represented by the market price. Yes. Market price. Current price. That is current. Value of the company shares is represented by the market price. That is not the past. That is not the future. That is the current. So if today, if you are purchasing this H&B bag, PLC company share at 150, if you agree, if you okay to purchase or if you okay to invest H&B bag company shares 150, it means that I would say that this 150 current market price is what? Now today you are investing at 150. Suppose that you are investing for the 6 months. Your investment period is 6 months. So this 150 is equal to present value of this expected dividends and expected capital gains. You are okay to purchase this company share at 150. This is the market price. This is the value of the company share today. Right? If the market is sufficient, appropriately, this 150 is what? If you are investing for the 6-month period, during this period you will get dividend and also you will get capital gain. Shares on investor of company dividends and capital gains. You will get some dividends if the company pay the dividend, and also at the end of the investment period you will sell and you will get some capital gain. So this 150 is what? May expected dividend at a time, expected capital gain at a time. Where are the given commission? This 150 is what? That is the present value of this expected dividend and expected capital gain. Make other theory anyway, but when you reach to the end of this lecture series, you will realize this 150 market price is the present value of your expected cash flow. If 150 make a gun, may humble dividend take a time, may humble capital gain take a time, may gano where given to company. This is a big concept. Very simply, that is reflect present value of the expected your cash. Because then we are the investor node and simply then we are bank with shares. Then you are going to the market. I am going to invest for the 6 months. During the 6 months, company will pay 5 rupees dividend. At the end of the 6 months, I will sell shares at the 200 like. So you are forecasting. As an investor, you are analyzing it. Then other investor for the future returns. Then you are investing today for the future returns. If you are purchasing this company share at 150 today, you are analyzing the future. Future returns so that means that this 150 is the present value of your expected future cash flow. Market price is a reflection of shareholders' perception of the quality of the firm's financial history. That is what I get. That company the dividend given the ඊළඟ මාස 6 තුල profit තිබුණා. During the next 6 months, this price will increase if economy is perform well. The price එක වැඩි economy එක හොඳට තිබුණා. එතකොට මේ price එක that is market price is a reflection of what? Shareholders' perception of the quality of firm's financial operation, financial distance. This is a big concept, right? Make a theory, but anyway, you should realize. So this is very conceptual thing. So this market price reflect the future operations of the company. Market price එක වැඩි වෙනවා කියන්නේ අපිට එකෙන් imply කරනවා මෙයාලා හොඳ investment වලට යනවා මෙයාලා හොඳ සල්ලි තියෙනවා, so that is implied. So that is the future operations. Wealth created by a company through its action is reflected in the market value of the company share. මම හිතන එක තේරුණා. Wealth creation එක පෙන්නුම් කරන්නේ it reflecting the market price of the share. Hence, wealth maximization reflects maximizing the market value of its shares. Market price serve as the firm performance indicator. ඒකට ඔයාලා research කරනකොට company के performance measure කරන්න market price එක. If you are doing research, or you do the research, you are doing the market stock return or related performance related research. So company performance you can measure by taking the market price. How we give index based on the market price. I think this is very broad area, right? But anyway, just relax enough, put that in a clear word, so then you will realize. This is in broad sense. If you are looking at that, because right. Now I think that's the objective of financial management. That's all I think. Right. So these are the characteristics of the wealth maximization objective. Focus on the share market price. Yes. And wealth maximization objective is focused on the share market price. Current market price. Current market price reflects future operations of the company. It is impersonal, like profit. Nobody can manipulate it. It depends on the demand and supply. So therefore, it is an impersonal objective. Concern timing and risk of the benefits. You will not realize this point today, but anyway, this 150 is the present value of expected dividend, present value of the expected capital gains. Theoretically. The present value, when you calculate the present value, is the expected cash flows, you are adjusting for the time and risk. ඊළඟ පාඩම time value of money එකේදී ඒක තමයි කරන්නේ. So this expected cash flows you are adjusting for the time and risk. Avoid high level of risk. Normally the value, this is value now. So value we are calculating. I will explain very simply, right? The value is equal expected cash flow discounted by some discount factor. There are one discount. Okay? We told that you are discounting, no? Right? So this expected cash flow may be dividend, capital gains. You are discounting using some discount factor. Where discount factor is some premium for the time, some premium for the risk. We will discuss in detail, right? So normally, when the discount factor is increasing, what happens to the value? May factor ka value will make a percentage. So we can calculate it. In the risk and return, we are determining this risk premium. So when the risk factor, discount factor is increasing, if it is increased, what happens to the value? Value is decreasing. So this factor, say risk factor, and the value is negatively related there. It is negatively related. So therefore, as an investor, as a finance manager, you should avoid high level of risk. The fundamental. What are the risk that will make it? The factor is increasing. If it increase, value make a fall. The value make a fall and what wealth figure is decrease. Encourage pay dividend. Dividend means cash flow. When the cash flow is increasing, value is increasing. So this objective encourage to pay dividend. So when the dividend is or the cash flows are increasing, you can increase the value. Right? So this is fundamental model of value calculation. So with that relationship, you can understand these attributes and growth oriented. Ultimately, when the value is increasing, company value is increasing, growth, ultimately company growth is there. So that is growth oriented. You should read reading material. Right. Now I have a question. What is the question? Question is, now so far we discussed the wealth maximization, value maximization, the objective of financial management related to the Related to what? Which company? Public dividend company. Company with the shares. Okay. Shares. Now suppose that you have the sole proprietorship, partnership, or shares. How to achieve this objective? You get one. And financial management is the objective of the company with the undertaking. They take the Yaba, Buddha, the Product, So how to achieve the objective for the sole proprietorship partnership? The same objective, creating value, maximizing owner's wealth. Same, that is not different. How to achieve it? And the PLC company concept, take a clear. Maximizing market price of the share. How this clear? If it is a sole proprietorship. How to maximize owner's wealth? Just think about it. And just tell me how. It's around maximizing market price of the share. So how to maximize your wealth? How to create value for the business? By maximizing what? By maximizing market price of the share. In a sole proprietorship, by maximizing what? Customer satisfaction. Whether goodness, goodwill. Owners will take a maximize their economic with the harm asking. Market return, what is the market? Now, market return you can calculate based on the price, the market share price. Market return again, now the price, current price, the difference, that is the return. So with that way, for the sole proprietorship partnership, what is the return? You can apply them. You should know, maybe one of the question we have a very simple question. Maximizing. Debitors.
Capital. Maximizing the capital.
Capital. Capital is like any other, then Mama may take the bank loan and current and maximize them. What is that? Maximizing. Now here for the PLC company, maximizing market price of the share. PLC companies that share means in a PLC company, that is the ownership. Okay. If you have 100 shares of the HNB Bank PLC, it means that you are an owner. Okay. You are a shareholder, you are owner of that company. So in a PLC company, public dividend company, you are achieving this objective by maximizing market price of the share. Ownership is shares of that company ownership, that is the ownership. Okay. So then when you apply this thing for a sole proprietorship, partnership, how to maximize the wealth? How to maximize the value? By maximizing what? It goes now. By maximizing liquidate value. What is the liquidate value? Selling price. Now suppose that you have a business in your village in a very, say, a very attractive place, very good location in that place. Suppose now there are certain demand from the outsiders to purchase this one for the 1 million. Right? You are not selling. After 6 months, then there is a demand because this is a good business, good location and everything is there. So now they are asking for the 1.5 million. That is the selling price. Liquidate value. In singular, that is the liquidate value. If you can maximize that selling price, liquidate value, property can develop, so you can create value. So if you maximize the liquidate value, you are benefiting. The sole proprietorship එක ownership එක reflect කරන්නේ selling price. Business එකේ selling price. Business liquidate value. මෙතන PLC company එක share එක කියලා කියන්නේ business එකේ ownership. ඒක maximize කරගන්න ඕනේ. So that difference is there. Liquidate value. Colombia liquidate value. Okay. Objective is clear. Right. Any question? Last discussion, that is agency relationship and agency conflict. Any questions, any clarifications after this? Don't worry about this diagram, right? Every decision, investment, liquidity, working capital, financing, dividend, whatever, there is a trade-off between risk and return. ඒක තමයි අපි discount rate එකත් එක්ක adjust කරන්නේ. So there is a trade-off between risk and return. Because you know that risk and return, higher the risk, higher the expected return. That is positively related. When you are taking a dividend decision, it involves, there is a trade-off of the risk and return. So you have to consider when you are taking this every decision, this trade-off, right? When you are reaching to the end of this lecture series, you will realize this trade-off. Therefore, the every action of the finance manager, risk return trade-off we have to consider. Right. Any questions? Anything? Right. No question. Ask.
Can you repeat the explanation about the dividend declaration?
Sorry. Dividend declaration. Dividend for PLC company, there will be a dividend declaration, right? So from the earned profit, they decide certain percentage to pay as the dividend. We call it as the payout ratio. If they pay, say, 5% as the dividend from the profit, 95% is the retention. Okay? 95% so that is the dividend policy. So you are asking how it affect to the value. Yeah, when a dividend is paid, suppose that there is a company, there is a regular dividend payment. Every year they are paying. Every quarter there is an incoming dividend. If there is a stable payment of dividend, it implies that that company is mature. There is a stable cash flow, there is a stable profit, they can pay the dividend. So as an investor, when I look at such company, if I am interested about the dividend income, so I am investing on that company. So then when I invest in me, I am demanding shares of that company. The demand the price is going up. So when the price is going up, wealth of the shareholders, existing shareholders, as well as if I am an investor, my wealth is increased. This is not happening made one day, overnight, living. So this is a long journey. If it is and also suppose that when the company is paying dividend, dividend payment implies that 95% company dividend given. From the profit, 95% they have paid dividend. Is it a good signal or bad signal? Bad signal. It means that investment plan. From the profit, from the total profit, 100, say 100. 95% they pay dividend, only 5% they have retained. So it implies that they are not going to do the investment. There is a problem of the investment. So in such a situation, it's a negative information to the market. It's a negative information to the market. If a negative information existing shareholders are then the cash flow of the media, then we are not a cash flow problems and we are not big problem. So they are selling to their shares. Selling supply is increasing. Market selling and supply when the supply is increasing, What is the price? Economic theory, supply is increasing, price is decreasing. So when the price is decreasing, when this. So dividends may exactly created on the that depends on the analysis. If it is a very stable company, it's a good signal. So that affects the value creation. If it is an unstable company, that's affects the value destroyed. So that is based on the signal. Am I answering the question? I'm telling again, right? Don't depends on this discussion only. You should read. Go to the reading material, other textbooks, you may read. When you come to the next day, you may come up with a lot of questions. But anyway, we can learn. The mass here so if you have a certain question, if I can't answer at that point, I will go, I will search, and I will try. Right? Okay. Right. It is a problem. Last point. Right. These are the types of organization. I think no need to explain this thing. When it's come to the sole proprietorship and partnership, if you have, I think you have learned this in the A levels also. For the companies, there is a legal entity, dividend liability, separated ownership from the country. This point is important. What is legal entity? Can anyone explain quickly? What is legal entity? Is there a legal entity for the partnership? Sole proprietorship? No. Yes. There is no legal entity for the sole proprietorship in any case, in any court case or any legal action. That partnership for the sole proprietorship has to go with the owner's own name, not from the company business name. So that is legal entity, not single and legal. So there is no legal entity. Limited liability. But for the company, public limited company, private companies, there is a legal entity. Now say that you are taking a Highland yogurt today. There is a problem with that. So if you want to take a legal action, you can go with the name of the Highland. You are not going with the main owners of the company. You may go to the court action or whatever the complaints with the name of the Highland. So that is the legal name. You can use the business name because business company name itself is a legal person. Right? Limited liability, you know that in the company, suppose that in this company, you have invested 150,000. Abhi tum HMB bankrupt hua. How much you ultimate loss? Bank motorcycle this is your liability. That is we call limited liability. But suppose that you have the part sole proprietorship, business bankrupt. Ministry that is the meaning. Limited, unlimited liability. So you have to use your personal properties, personal asset to recover to settle the liabilities because that is unlimited. What is this? This is important. Separated ownership and control. When it's come to the public limited company, PLC company, ownership has separated from the management. Owners are the shareholders. Operations management are doing by managers. There are finance manager, production manager, marketing manager, HR manager. They are not the owners. They are not the owners. But if you take your sole proprietorship, owner manager accountant production, everything is you are paying by yourself. There is no separation of ownership from the management. For the partnership, for the sole proprietorship, there is no separation. Right? But for the PLC company, public limited company, private company, there is a separation of ownership from the management. Right? because of this separation of ownership from the management, they are arising a problem. We call it as an agency problem. So that is what we are going to discuss. So then there is no agency conflict. There is no agency problem for the sole proprietorship and partnership. Why? No separation. Idea පාලනේ වෙන් වෙලා නැහැ. There is no separation from ownership from the company. But for the companies, there is a separation. Because of this nature, a conflict will arise between shareholders and managers. That is we call agency conflict. Because in the company, corporation, owners are the shareholders, so they are the principal. So director board or the shareholders recruit managers for doing the business, for the operation activities. So they are the agents. So there is a principal agent relationship between shareholders and managers. We have recruited managers to maximize our wealth. Managers now අරගෙන තියෙනවා අයිතිකරුවන්ගේ ධනය උපරිම කරන්න. That is the objective. No? So we have recruited managers to maximize shareholders' wealth. That is the nature. Now there is an agency relationship between shareholders and managers. Shareholders are the principal, managers are the agent. So agent කෙනෙක් කියන්නේ කවුද කියලා දන්නවනේ අපි තෑවකාරයෙක් agent කෙනෙක් පත් කරගන්නේ අපේ යම්කිසි වැඩක් අපිට අපේ කරන්න ඕන එකක් අපි යාලි කියලා මේක කරන්න කියලා. So that kind of thing. So that is the agency relation. So we have recruited managers to maximize our wealth. Our objective is to maximize. So maximize our wealth. So in reality, what is happening? In reality, what is happening? You can see shareholders are the owners. Directors are elected by the shareholders. Deals with the broad policy. Managers are hired for the most of the operating level decision. So that is the way of governing corporation, company. So there is the agency relationship between shareholders and managers. Because of this agency relationship, agency conflict can arise. Why agency conflict is arising? Because now you know that we have recruited managers to maximize our wealth. Then අපි හිතමුකෝ මෙහෙම දෙයක්. There is a project. There is a project. Investment. So this is very risky. We have to invest large amount of money, 1 million, large amount of money. The return of this investment, company will get after 5 years or 20 years, long term. This is very risky, right? So now finance manager is evaluating this project because he is the person evaluating this project, so budgeting. So then when he is evaluating, he may feel as a human being, if this project investment failed, because return is receiving after 5 years, we are investing large amount of money today for this particular project. If uncertainty is there, long term means uncertainty. So if this project, this investment is failed, they have a problem. There is a threat for their job security, for their salaries, for their other benefits, survival. As a human being, is feeling like this. If this project is success, ultimately return is going to boom. The long run, or if this project is ultimately succeed, the return or the value is going to go, directly go to whom? Owners, shareholders, because they are the risk takers. They are the risk takers, so the return is going to them. But anyway, the benefit is there. But anyway, directly return is going to the shareholder. Okay, long term. The way long term we can make a failure, so they will feel that ultimately we have to go home. So they are feeling like this. So then what happens? As a human being, they are trying to shows the director board. This project is a success. This cannot be failed. This can be failed. So likewise, they are pretending. So they are trying to pretend this project is not good, even though this is a value created project. Value created project එකක් නමුත් මෙයා ඒක pretend කරනවා this is not good, this can be risky. So likewise providing the wrong information, presenting the negative way, so they are presenting like this, so then convincing this is not good, but really value created good project. So then conflict. So what happens ultimately, good investment, good project is lost because of the behavior of these managers, behavior of this management. So then conflict can arise. So you can see that managers are the agents of the shareholders. Managers make decisions that conflict with the best interest of the shareholders. As I explained now. Shareholder can handle high risk, high return. So they are taking high risk because of the high expected return. So they are trying to take risk because they want to create wealth. But managers level and comfort zone living. So they are trying to satisfy, survive their make comfort reality salary. So right, so this is a human made problem maker. So this conflict can arise. Separation of ownership and controls allow share ownership to change freely, but results in this possibility. Third bullet, third bullet. The advantage of separation of ownership from the control. The ownership you can change easily. In this case, you are the owner of the equity bank. You are having 1,000 shares. If you want to give up this ownership, simply you can sell the shares. Mama ඔයාට විකුණනවා දැන් මම ඕන කෙනෙක් නෙමෙයි දැන් ඔයා ඕන කෙනෙක්. ඒක අපිට බොහොම easily කරන්න පුළුවන් because of the separation of ownership from the control. So I can sell the shares and then I can give up my ownership. But in a sole proprietorship, can you do like this? Or put on the ownership together. So the advantage of this character, the separation of ownership from the control is easily you can change, freely you can change the ownership, but the problem is what? Agency problem. So with the agency problem, agency cost can arise. I'm not going to explain this one because I can see you have exhausted. Two versions are there. You should read and for two agency conflicts can arise. One is with the manager versus, shareholder versus manager. Agency conflict. The other one is shareholder versus debt holder. Right? Two versions are there in the agency conflict. So you should read. You should come with the proper reading. I'm asking one of you. I will give the voluntary presenter. So you have to explain what is the shareholder versus manager problem, what is the shareholder versus debt holder, right? That is explained in the slides. And also, I will show you, this is the agency problem, shareholder versus managers. The other one is the shareholder versus bond holder, debt holder, this version. And finally, how to remedies, how to control this problem. You can see it is explaining, you should come with the proper reading, and also the cost of the agency problem. The agency relationship again is the agency conflict. This is cost. Company agency cost. Right? Restructuring, monitoring, bonding, lost opportunities. I will explain. But anyway, you come first with the reading. And also sources of agency problem. So sources is clear. Sources is what? Own utility. Tamange dane maximize කරන්න යනවා managers. ඕනගේ dane නෙමෙයි. එයාගේ. Long run survival. එයාලා බලන්නේ risk එක ඒව ගන්න නැහැ. එයාලගේ job එක තියාගෙන යන්න තමයි බලන්නේ. They don't need to growth of the company, value of the company. They want to their salary monthly level. So that is loan transfer. Consumption of the job requisite. Other benefits, vehicle loans, housing loans, accommodations, so there are certain other benefits, so they are given these things. So these are the sources of agency problem. These are the costs related to this agency problem. Some remedies, actions that we can take to manage this. So you should come with the proper reading. Commander, වැඩක් එපා. I came with some high expectation to complete both the introduction, financial market, financial environment. But anyway, I have lost my expectation because I have some story. Because the next week, the 1 year, cash with the government. And if you want to express what you are young from here, that is just about the net. But anyway, this is homework, so you have to come to the property. And the other thing, this one. I'm not taking much time in the next week for the area, so you have to come with the proper reading. This one, financial market, financial system, you should come with the proper reading. Because these are not things to teach in the classroom. As a habit, go to the central bank website. There are a lot of information in the CBSL website. How much the today's inflation? You are learning business finance. How about the today's inflation in the Sri Lanka? What are the stock market indices? You have to read, right? So these are related to this financial system and financial market. So guideline is there. So you go to these slides, read this thing. So I'm taking very small time to spend discuss on this thing. So if you come with a better reading, so I can explain more important points only. And additionally, you should go to this website. Right? There are some links, go and read. And also this for the global financial market related information. We are in a highly digitalized environment. So you should know what is happening in the global financial market. There are certain development, blockchain, cryptocurrencies, green marketing, green finance, certain things are there. I hope my presentation based good presentation and the assignment based on these areas. Newly development in the financial markets, right? So you will have to have some topics. So you have to collect some information. You have to present. Certain developments are there. AI, digital currencies. So you should prepare for that. I will announce them at the assignment. So go to this website. These are very informative. Continuously updated in the global financial context, so you should prefer. In addition to that, in Sri Lankan context, at least, right? At least global say the Lanka, right? You have to look at this thing. This is SEC, Security Exchange Commission, governing body of the Colombo Stock Exchange. Go and read. What is the structure? What are the things? Lot of information are there related to the Colombo stock market, listing requirements, rules and regulations. Just read. Don't take them by heart. You must read to get some information. And also this one, Central Bank of Sri Lanka. Look at the inflation. I asked that question. 2.8. Unbelievable. CM they got inflation in the right? So look at this website. Anyway, this is our main Central Bank Sri Lanka. this is important financial system of the Sri Lanka. So you should read this financial system consists with the financial market, financial intermediaries, what is infrastructure, everything is explained, right? And the other thing, you can access this website either in English, Sinhala or Tamil. If you need to have this read in the Sinhala language, just click this and go to in Sinhala. So you can get many things written. And also you can access in the Tamil notes, right? So you should read because my first quiz based on this financial environment and financial system. So you should read. And also the other one is CSC.lk, Colombo Stock Exchange. What are the listed companies? What are the sectors? How many sectors are there in Sri Lanka? Our economy, you can overview with these sectors. What are the sectors? What are the indices? Performance indicators. You should read, right? Everything is there. Even in the Sinhala, you can read this one also. Right. So mandatory things, right? CBSL, CSC.lk, Security Exchange Commission is mandatory. You should read because that is related to the financial environment. Financial manager cannot play this role. I forget to tell that one. Financial manager cannot play this role without knowing the knowledge about this financial market, financial environment, financial system, even the global financial market, right? So in order to play this role effectively, efficiently, you should have a vast comprehensive knowledge about this happening in the market because that is dynamic. It is changing. So therefore, these website references are mandatory things you should read. So in the next day, I'm trying to start the time value of money. I will take probably 1 hour for this financial market system and the conflict agency problem and the tutorial things. So then I'm starting time value of money. If you have time, just read that chapter also. I will upload the link. Fine. Right. Anyway, any questions I did less submission? Any questions, any clarifications, anything you need to ask related to this or one day? You take within the group details, right? I will announce the group maybe 6 minutes. But I will contact details will be in case if I want to communicate, I will communicate with whoever. Are you happy about the business finance? Next day, you know. Sure. Any question? Right. Okay, then we'll meet in the next week. I have my email contacts. Oh, well, sorry. So you can put the email any questions you have. Okay. Still you have a time to ask if you have any question, right?
Excuse me, madam.
Yes.
This financial system presentation,
Yes.
the 15th slide, there's some that the wordings we cannot see. I think some font error or something maybe.
Yeah, correct. Don't worry about that one. The English version, I think it is there. This one. Right? The same in the Sinhala translation I have included. I have extracted this from the Central Bank website. All the things in this financial market and system contain directly from that website. So therefore, you better read that one. Don't worry about that one. This slide explain that one. Same thing, right? Okay.
Okay, madam.
Do you have any questions? Those who are in the virtually. Next time I'm inviting you to come physically. Right, anyway, thank you very much for your contact.